All right, let's jump right into this explainer. Today, we're impartially decoding the highly anticipated Manipal Health Enterprises red herring prospectus. Whether you're a seasoned investor or you just happen to be tracking the Indian healthcare sector, our goal today is to cut through the noise, break down this massive document, and help you make an informed judgment on what is absolutely shaping up to be a landmark public offering.
You know, the sheer brand recognition Manipal has built over the years, it's honestly undeniable. You see that logo, and you instantly think of major healthcare infrastructure. They really aren't just a regional player anymore. They've become a dominant driving force across multiple states in India. And this IPO? Well, it's basically the culmination of years of really aggressive strategic positioning. Which brings us to the actual physical scale of their operations today. 13,037. Just let that number sink in for a second. That is the staggering number of licensed beds Manipal projects to operate within its network by March 2026. In the hospital business, bed count is literally the ultimate metric of scale and capacity. Operating over 13,000 beds makes Manipal an absolute behemoth in the Indian healthcare sector. It gives them massive leverage when it comes to economies of scale, talent acquisition, and, of course, market pricing.
So here's our roadmap for evaluating this IPO through an investor's lens. First, unpacking the offer details. Next, the healthcare growth engine. Third, their future expansion playbook. And finally, the crucial investment risks. Okay, Section 1, unpacking the offer details, the pitch. So the IPO is basically split right down the middle into two distinct parts. First up, we've got a massive fresh issue of 80,000 million rupees. Now, that is fresh capital being injected directly into the company's balance sheet, which they're planning to use for prepaying borrowings and funding future growth. But balanced alongside that is an offer for sale, or OFS, consisting of over 21.6 million existing equity shares. Keep in mind, the money from this OFS does not go to the company, it goes straight into the pockets of the existing shareholders who are selling. Which brings us to the obvious question. Exactly who is cashing out or reducing their exposure here? Well, we're seeing some major institutional investors and promoter groups taking a few chips off the table. This includes heavyweights like TPG, Novo Holdings, and Imperius Healthcare. Look, for these early and growth stage backers, this IPO represents a major liquidity event. It's totally normal for private equity to seek an exit, but as an incoming retail or institutional investor, you always want to be acutely aware of exactly whose shares you're buying. Moving right along to Section 2, the healthcare growth engine, the performance. Ultimately, it all comes down to top-line growth, right? And Manipal boasts a seriously aggressive revenue compound annual growth rate, 29.41% from healthcare services between fiscal 2024 and 2026. According to the industry reports cited in the prospectus, that was literally the highest revenue growth among the set of major hospital players in that timeframe. They are outpacing their peers, plain and simple. But how exactly are they achieving this industry-leading growth? Well, here's the thing. This growth wasn't just organic. They didn't just build this empire brick by brick. It was heavily fueled by a relentless acquisition spree. In 2021, they absorbed Columbia Asia and Vikram Hospital. In 2023, they moved into Eastern India with AMRI hospitals, followed by Medica Synergy in 2024. And most recently, they snapped up a near 90% stake in Sahdri Hospitals in late 2025. They are aggressively buying market share, cementing their footprint from their home base in Bangalore, straight through Maharashtra, and all the way into Eastern India. All right, let's look ahead. Section 3, Future Expansion Playbook, the Growth Strategy. They're balancing two very different physical expansion strategies here. First, there's the brownfield expansion, adding 483 beds to existing hospitals. This is definitely the safe play. It requires lower capital expenditure, it utilizes the existing hospital infrastructure and staffing, and generally, you reach break-even much faster. But to contrast that, we have their greenfield expansion, a massive 1,943 bed plan. We're talking entirely new constructions built from the ground up, heavily targeted in Karnataka and Maharashtra. And you've got to remember, greenfield projects carry a much higher initial risk, simply because they require significant time and capital to build before they ever see a single paying patient. Now for the most critical part of this explainer. Section 4, Crucial Investment Risks, the protection. Okay, so the RHP is a beast of a document, over 600 pages, and the risk factor section is where they legally have to lay all their cards on the table. Remember that massive acquisition timeline we just talked about? Well, the RHP explicitly states they cannot guarantee the successful integration of these recent massive acquisitions. They specifically call out risks regarding corporate governance, integration, and managing minority shareholder interests. Think about it. When you buy multiple large hospital chains, each with totally different cultures, IT systems, and doctors, stitching them all together into one unified, profitable machine, that poses a severe operational hurdle.
And to put a real hard financial number to that integration risk, we just need to look at their most recent major purchase. Their late 2025 acquisition, Sahyadri Hospitals, actually incurred a post-tax loss of 485.34 million rupees in fiscal 2026. This happens all the time. When you buy distressed or transitioning assets to fuel that incredible top-line growth, you often end up inheriting their bottom-line struggles in the short term. And digging into the financial disclosures, Sahyadri actually isn't the only one in the red. Multiple subsidiaries, including HealthMap Diagnostics and Manipal Hospitals Bengal, have historically reported net losses. The prospectus flat out warns that any future operating losses or impairment charges from these subsidiaries could act like an anchor. It could drag down the overall profitability of the parent company, no matter how amazing that top-line revenue looks. But it's not all just balance sheet stuff. There are literal physical risks on the ground. The company highlights potential delays in those massive 1,900-bed greenfield constructions we discussed earlier. They also note uncertainties and defects in titles for land they lease. But perhaps the wildest disclosure? Ongoing government allegations regarding land encroachment on a stormwater drain at their Varthur Road facility in Bengaluru. The RHP states that an adverse decision there could result in government authorities actually removing installations at that hospital. That is a very tangible operational threat that absolutely cannot be ignored.
So, as we wrap up this explainer, here's the ultimate question you really need to ask yourself before investing. Does their undeniable industry-leading growth and super ambitious 2030 expansion roadmap outweigh the heavy integration challenges, the subsidiary losses, and the physical legal caveats? Look, Manipal is without a doubt a total powerhouse in Indian healthcare, but growth at this sheer velocity, it always comes with growing pains. Ultimately, it's up to you to decide if the price is right for the journey ahead.